All right, well, hello, everybody, and welcome to a series of conversations for year-end tax planning and then just general tax planning to help you make good decisions about your money and some thoughtful tax planning. Now, this is a timely conversation we have every year about this time to help you make better decisions and take advantage of last-minute tax planning opportunities and also plan for the year ahead. And this year, it's a especially important topic given the number of important tax changes that our current administration is proposing. And that is why I decided to invite a few tax leaders from our professional community to hear from them firsthand what they may recommend for a variety of situations you may be facing. Now, in this particular conversation, I have the pleasure of speaking with Justin Miller, who is a highly respected, knowledgeable, and passionate tax attorney who has a number of acronyms behind his name, including a JD, an LLM in taxation. He's a trust and estates practitioner, an AEP, which is an accredited estate planner, and a CFP, a certified financial planner. On top of it all, Justin is a partner and national director of wealth planning at Evercore Wealth Management, and he's a managing director at Evercore Trust Company. Now, all of this means that Justin is very knowledgeable, particularly at the intersection of law, tax, and wealth planning. And Justin is also an adjunct professor at Golden Gate University School of Law, a fellow of the American Bar Association, and a fellow of the American College of Trust and Estate Counsel. But above all, he has become a personal, professional friend whom I trust, I respect, and I want to thank Justin for sharing his time with us today. So, Justin, thank you, and welcome.
Well, thank you, Roman. We should stop right there after that introduction. I can only disappoint people after, but no, such a pleasure to be here. And anything that I can do together with you to help people, that's what we're here to talk about.
And I really appreciate that on behalf of everybody who's a Pillar 6 community, whether they're clients and friends. And thank you. Now, I want to, Justin, break this into two segments because I know there are two really important topics that you're particularly passionate and well-versed in. And I think that these are also very much top of mind for a lot of our clients as well. First, I want to talk about the biggest proposed income tax changes that you're seeing and how they might impact individuals and trusts. And then second, I wanted to shift and talk about the tax consequences of crypto, which is another very hot topic, especially here in the Bay Area. So without further ado, let's dive into the first part of the conversation, talk about the proposals. And I suppose the first question I've got for you is, well, what are some of the, not only the biggest tax changes you're seeing, but also those likely to be written into law?
All right. I mean, there's so many. We could talk for hours. There's thousands of pages out there. But let me break it down into sort of the big ones. What are we seeing? What's been proposed? Now, we do have a proposed House bill. It's out there. Senate, at least as of today, October 25th, they're still working on their version. So we could see some changes, some tweaks. But what we're looking at right now are a couple themes. So let's just start with, it looks like corporate taxes will go up. They were drastically cut with the Tax Cuts and Jobs Act in 2017. Current corporate tax rate, 21%. They're talking about pushing it up to maybe 26.5%. Remember, it used to be 35%. So they could push it back up. But I want to make clear that this is simply a change in rates. So when people talk about, you hear the publicity about like the Amazons of the world paying zero tax. Raising the rates doesn't change that at all. Whether it's a 26%, 21%, or 99% rate, if you don't owe any taxes, it doesn't matter what your tax rate is. So no changes to what's going on already with corporations. All it really changes is the companies that already pay taxes, such as the banking industry, the oil and gas industry, certain industries already pay corporate taxes. Those industries will get hit harder. And the ones that already are paying zero taxes will just continue to pay zero taxes. Not many big changes there other than rates. But in our world, when we look at individuals, when we look at families, we can break it down into income taxes and estate and gift taxes. Total different regimes. But income taxes, we are absolutely looking at an increase in income tax rates. It's been proposed, it's been promised. Seems to be sufficient support to get it passed. Now, what kind of rates could we see? Well, right now, the proposal is just to go back for ordinary income. It was 39.6% a few years ago. They want to push it back up to 39.6%. That's for things like bond interest and salaries. Now, there's still on top of that a 3.8% net investment income tax. That doesn't change. And then on top of that, there's a proposal to get another 3% tax for people that make more than $5 million. So we're really looking at a top rate of 46.4%. If you add, we're lucky enough, we're fortunate enough to be in California, you add our top tax rate in California, you're looking at a combined tax rate of close to 60% at the highest level. That's ordinary income. For capital gains, there was a proposal for wealthier people to tax capital gains like ordinary income, meaning a top rate. Like in California, we don't distinguish between interest and capital gains. They're all taxed at the same rate. But there is the proposal to keep a preference for capital gains and qualified dividends. So it will still be a preference. It means a lower rate, but that rate will go up. That's what the proposal is. So right now we have a top rate of 20%. The proposal is to move it up to closer to a 25%. Now you'll still have a 3.8% on top of that. And there's a proposal for people with 5 million or more to get an extra 3% on top of that. So we're looking at a total top rate there of 31.8%, which is a little bit higher for sure. And that certainly will dissuade some selling, but it's not as bad as Biden's original proposal to just eliminate the preference totally. The other thing to point out, though, because we are in a world where people either are beneficiaries of trust or creating trust, those rates kick in at a really, really low level for trusts and estates. And that means, whereas let's say for us, the point of these new rates aren't to really kick in until people are making roughly more than $400,000. For trusts, a lot of those rates, the highest rates start to kick in at $12,500. So what that means is, and we both have, we have children, if we pass away, and if we're not in the highest tax bracket right now as individuals, when we pass away, if we have a trust taking care of our minor children, very likely those trusts just over $12,500 are going to be paying a lot more in taxes.
So Justin, let's just take a quick step back and let's talk about the individuals and our own personal income tax rate. So you'd mentioned that under the current proposal, and one that's likely gaining a lot of support, we'll see a significant, or to some extent, significant increase in our taxes, upwards of that 60%. Now, I know you don't have like the exact thresholds at which point those kick in, but do you have a rough sense of who those higher tax brackets are likely to affect? And what about sort of the mass Bay Area, maybe even Western US salary ranges?
Yeah, so the one thing that's been promised, and don't get me wrong, some of these rates will hit people depending on what their financial situations are, but generally what's been promised is only to raise it for people making more than 400,000. That's the one thing, and the idea that it might not feel like a ton of money for people in the Bay Area, for the country as a whole, that is certainly a lot of money. Now, what's interesting about this, though, and who's going to end up getting hit with the brunt of this, especially let's look at the capital gains. Now, the reality is it's going to hit usually the people that need to sell, that don't have a choice, that are, so the very, very wealthy, when we talk about people with hundreds of millions or even billions of dollars, they have the luxury of not needing to sell. They can borrow against their assets, or they can wait it out and think, oh, well, if I give it a few more years, the House and Senate are going to flip again, and then they're going to reverse all of this. So people that have enough money, they don't need to sell, that they can wait out these higher brackets until rates come down. What is really going to hit are a lot of the professionals, things like attorneys, doctors, accountants, wealth managers, those types of professionals, a lot of people that have not only college degrees, but graduate degrees. Oftentimes they have tons of loans outstanding. And the reality is they're people that work for a living. They get income that are, it's not necessarily from a huge concentrated stock position. So there is some more flexibility for the wealthiest people. But there was even a recent proposal today would only apply to billionaires. But you might have heard rumors about this wealth tax. This idea that we would have like a wealth tax, almost like an estate tax, but every single year on really wealthy people. This is what Senator Warren had proposed. Why don't, this is ridiculous. We have these super wealthy people. Why don't we charge them a tax on their wealth? There's a question of constitutionality. Is that even constitutional? It's not really a tax on income. That's what our 16th Amendment allows, is an exception to the Constitution. It came in with the 16th Amendment to say you can tax income, but a tax on wealth isn't really a tax on income. So what was proposed today, it's not in a bill, we haven't seen it yet, is a new deemed capital gains tax. So right now, we only pay tax on capital gains if you sell something. Well, like I said, people with lots of money that don't need to sell, they have a luxury. They can wait and maybe wait till rates get a little bit lower. So this deemed capital gains means even if you don't recognize the capital gain, even if you don't sell, the proposal, and we haven't seen it in written form yet, is to say for people, and we don't know where it's going to kick in, billionaires or how many billion, that if you have a certain net worth that has unrecognized gains, so think property that's gone up in value, stock that's gone up in value, even if you don't sell it, we could see a proposal to charge people capital gains tax, even if they don't sell. And I see you nodding. I've got one more point. I'll just add it on because I get excited about taxes. I could talk forever. But the other question is, when do these rates kick in? Now, what's really scary is the capital gains rate. It was proposed to kick in as of September 14th. We don't even have a bill yet. We don't have a final bill. Nobody's voted on anything yet. But the proposal is to make it effective. So let's say we have a client that sold a big chunk of stock on September 14th, thinking they're only going to pay a 20% rate. They might find out that they're paying closer to a 28.8 or even more, 31% rate, depending on what it is. And the question is, can you do that? Can you make this type of retroactive change that the person did the sale under current law? Can you really retroactively go back and change rates? And unfortunately, the answer is yes. It was done in 1993 with President Clinton, where they raised rates in August. So you might have had someone that had an income event in January of 93 thinking they only owed a 31% rate. And then lo and behold, they find out in August, the bill signed, that it went up to a 39.6% rate. Totally constitutional. Now, usually it's bad political policy and that a lot of people are not reelected when you put in retroactive rates. And what happened, even though President Clinton was reelected, the House and the Senate did flip after that and the Democrats lost control. So it's politically unpopular, but it is possible to see retroactive changes.
Yeah, that was actually going to be the exact next question, is what do you anticipate to pass or be implemented this year? And as we sit here today, it's end of October. And, we only have about 2 months left to do any sort of tax planning, if there are any opportunities, and how concerned should we be about these proposals? And do you have any read on that?
Yeah, so the reality, and it's not a time to panic, it's a time to be prudent, time to work with your advisors. We'll get to the estate planning, where there could be a huge rush to get some of the estate tax planning in. But from an income tax perspective, I think it's safe to assume that rates could go up, both for ordinary income, capital gains, and qualified dividends. What the effective date is, we won't know. It'd be very easy to just say January 1, 2022, but there is sufficient political support for bumping those rates back up. And even the government's own studies have said with somewhere around a 28% capital gains rate, it should materially change people's decisions to sell, that people will continue to, but as you start going above that 28% rate, even the government studies imply that you'll actually collect less money as a government with higher rates because people will be less likely to sell. Mm-hmm. So that 28% is kind of the tipping point for a lot of these studies. So we certainly could see that 25% rate plus the 3.8% rate. The rates are pretty easy to change. I think there's not a lot of controversy. Do we have at least 50 senator support? And the answer is we might. Some of the other bigger changes are still up in the air, and it also has to do with how much we're planning to spend. If we're planning, and that was the original reconciliation bill, the goal was to spend $3.5 trillion. Well, in order to spend $3.5 trillion, there had to be a ton of tax raises to pay for that $3.5 trillion. But if due to a political negotiation and getting 50 senators on board, just because you need unanimous 50 senators, if they agree that, okay, we're not going to put a $3.5 trillion, we only want to spend, let's say, 1.8 trillion. Well, that's a lot less tax revenue that they have to raise. So that means they can cut a lot of these tax hikes down. Maybe they'll bring the rate a little bit down. Maybe they'll eliminate some of these other tax provisions because they won't need to raise as many trillions of dollars of revenue if they're not spending as many trillions of dollars of revenue.
Right. Well, so I think it's safe to say that most folks in our community are not yet in the billions range. And so there may be some pressures where they may need to sell, or they may not have the benefit of some of the income planning. So just a quick recap. Where we stand today and the things that I hear most often as a concern about taxes would be our income tax or earned income. We have capital gains. We have our dividend income. But then also there's a big amount of kind of questions around the tax around real estate. So especially investment real estate and the ability to do exchanges. So as we sit here right now, I know that some of these tax rates and tax bills can be retroactive, but do you think our income tax rate might go up before the end of the year? Or what about capital gains? I mean, difference between short and long, are those expected to increase? Dividends, and then do you think they're going to get away with getting rid of real estate or like for like property exchanges?
So the retroactivity is, so first of all, for the ordinary income increase, the proposal was January 1.
Of
I
this year.
think I wouldn't, we don't know what could happen. Even the politicians don't know, but having the capital gains portion retroactive, it could easily be changed to match that as of January 1. So we don't know. We don't even have a final bill. We don't have Senate's bill. The like-kind exchange for real estate, that might be a little easier to address. The Republicans already threatened to get rid of that. That was part of the 2017 Tax Cuts and Jobs Act. And what happened at the last minute, like-kind exchanges were supposed to absolutely disappear. Our real estate lobby in this country is very strong. And what they come in and they support a lot of our political process, and getting elected and having money to do things requires a lot of these lobbying organizations. And because of that, the last second almost end of 2017, real estate industry came in and said, hey, you've got to protect like-kind exchanges for real estate. And Congress agreed. They said, fine, you know what? Well, absolutely, we'll get rid of like-kind exchanges for everything. We'll talk about crypto in a little bit, but for everything except for real estate. And the reality is like-kind exchanges weren't even mentioned in the House bill. That's how much that they said they figured, look, if the Republicans can get rid of it, we certainly aren't in a position. The real estate lobby is very, very strong. So not a lot of risk there, but the certain things we'd love to see come back. Like, let's take the state and local tax deduction, which in California, this is going to hit all of us with high state income taxes, high property taxes. Most of us in property taxes alone for wealthy homes are more than $10,000, let alone our state income taxes on top of it. You can only deduct $10,000. Now, there is Democratic support, especially with constituents, because think of the states where this really impacts. High income tax states tend to be some of the blue Democratic states. New York, Connecticut, California. And so there certainly is desire to get rid of that limitation, allow us to deduct our state and local taxes. Unfortunately, it wasn't even touched, didn't even mention it in the House bill. We might see a little bit more relief in the Senate bill. The reason why it won't disappear is because it costs too much money. It would cost the government as much as our representatives might have promised or hoped or we wished or desired that we would, now that with the Democratic change, that they would help out these Democratic states. The reality is they're trying to spend money on programs. And in order to do that, they have to raise taxes, not collect less taxes. And by having that $10,000 limitation, if they were to get rid of that, they would collect even less revenue. So right now, it might be bumped up. We might see it go from 10,000 to 20,000, but really, I wouldn't expect any significant change because right now we're trying to figure out ways to pay for all this extra spending, not reduce taxes.
Yeah, that was definitely one of my next questions, and I don't like the answer, but I'll take it. You're the authority on it. So, given that we only have 2 months of the year left, do you have any recommendations or best practices? What are you telling your clients, especially the more affluent folks, anything they should be thinking about taking advantage of any last minute tax savings opportunities for this year, knowing what we know today?
So here are some of the big ones. First of all, we don't know whether there'll be retroactive capital gains taxes, but here's the one thing I think you can count on. And I'm going to make a bold prediction here, but I would not expect capital gains taxes to go any lower. Um,
Safe to
Best case
say.
scenario, if you're lucky, they could stay the same. Very likely they're going up. We don't know if they'd go up retroactively, but if you were looking to sell anyway, if you have a concentrated position, if you've got a business and you were going to sell this year or next year anyway because it made financial sense outside of taxes, you might as well go ahead and do it now. I mean, if it turns out it's retroactive, then it'll be the same rate this year or next year. But if you think this could only change will be happening in January 1st, have the higher rates, this might be the time to diversify, to get out of that concentrated position, sell your business if you were looking to sell it anyway. Same thing goes with the concept of converting IRAs to Roth IRAs. If you were headed that direction anyway, if it made financial sense, you might very likely be in a lower tax bracket today than you will down the road, as long as you have enough assets outside of your IRA to do that Roth IRA conversion. Where the real planning comes in, though, the real planning is going to deal with estate planning. And that's where if you've got enough money where you're facing gift and estate taxes, a lot of the strategies are going to disappear, at least according to the House proposal. And we don't know what the Senate proposal, we don't know what's going to make it final. And they're not going to necessarily disappear as of January 1. They will disappear as of date of enactment. Date of enactment means the date the president signs the bill. So for a lot of strategies that families have that are trying to pass wealth down to kids and grandkids and great-grandchildren, a lot of those they're called the grantor trust strategies, intentionally defective grantor trust, sales to idiots, grats, all these great acronyms that estate planners use. A lot of the bread and butter planning is going to disappear. Now, it doesn't mean you won't be able to do any planning, but the other thing that'll disappear as well is the ability today to every individual can give away 11.7 million completely tax-free. And that's set to be cut in half starting next year. So not only will the strategies disappear, but the amount of money you can give away tax-free could be cut in half. It was already set to be cut in half after 2025 anyway. They're just accelerating or potentially accelerating it to next year. So this is the last big chance to do really big estate planning.
So gifting is a big theme for 2021.
Yes. One thing I can also assure you is for any good trust and estate planning attorney out there, accountants that are working in this world, they're not going to be getting much sleep over the next few months. A lot of them probably already aren't getting enough sleep. It's going to be a very, very busy end to the year because it's pretty much clients are on notice. The House has already put it out there that we want to eliminate this. So now hopefully a lot of our clients that already have that level of wealth have already done some planning. But if it's a matter of maximizing and getting the optimal amount out, yeah, this is going to be one of the biggest rushes for the trust and estate community. And what it also means is starting next year, estate planning is going to go in a new direction. I mean, we might have to start using what are called non-grantor trusts or taxable trusts. So it doesn't mean it's disappearing, but it won't be as good. And it'll take some different strategies to make happen.
Right. So I think that most families that are potentially looking to pass about $11 million as a couple should be fine this year, next year, and beyond. But anyone above 11 millions in total assets that they're looking to pass on to the next generation or the next rising generation, not that they have a ton of time today, but it seems like they need to start doing something right now.
Right. And some of the wealthier families, the reality is it doesn't have to be these fancy schmancy strategies. It could be as simple as just creating a trust and putting assets into that trust. So there are some simpler ways, especially given the limited time. For some of the families with closely held businesses that have family partnerships or LLCs, things like that, discounting could disappear as well. The ability to get not just 11.7, but the discounted value of 11.7 that could be as much as $15-16 million. Right. Discounts are being proposed to disappear. So this could be the last chance to not only use these strategies, take advantage of discounts, but for estate planning, especially for wealthier families, this might be the end of the heyday.
Yeah. Well, I'm looking for some good news from you too, Justin. But just to wrap up this segment on personal planning as well as estate and trust planning, any other suggestions, any top of mind thoughts that you might recommend that individuals and families consider for the next couple of months?
Well, at least let me share the good news. The good news is it could have been worse. It still could be worse, but it could have been worse. Even with some of the proposals as part of Biden's American Families Plan, at least we still have a capital gains preference. We still have a benefit for qualified dividends. So at least you don't have to pay the highest tax rates on that. The difference also, the step up in basis at death, the idea of in California, a lot of our parents or grandparents have homes that have appreciated, or clients have homes that have appreciated in value. And there was a threat to get rid of the step up in basis. And even for a married couple in California, the beauty of community property is if one spouse dies, the capital gains disappear for the surviving spouse. Also, they can sell their house, they can move somewhere else and not have to worry about a huge capital gains hit. That was threatened to disappear under the proposal, the original American Families Plan.
That's right.
At least that's not in the House bill. But I'll leave you with the answer to your thought. And this is going to be my answer to everything. And that is, make sure every client, every potential prospective client out there, work with your advisors. It is so important. And make sure your advisors are working together. So that means your wealth advisor, your CPA or an accountant, your attorney, make sure they're part of a team. And if you've got good ones and they're looking out for you, if they're a collaborative team looking out for you, you are going to be best served in the long run.
That's a good advice. And we say the same thing to all of the families that we talk to, is make sure that you actually use your team as a team. Make sure they're talking to one another, because if you have really smart professionals and there's sort of looking at just one slice of the pie, they're giving you advice in a vacuum, it could never be as good as advice that's collaborative. So thanks for the reminder. All right, so let's wrap up this segment when we talk about the personal and the trust planning, and let's shift gears and talk about this mysterious world of crypto, which I think is confusing enough to people as it is. But now you add in the taxation of crypto, and our heads are about to explode. So I know that you're an expert in the area. You have a lot to share. Tell us about it.
So, we certainly don't know what the value is. That I haven't changed. It changes every second. I can't say whether it's a good or a bad investment. It certainly has a risky investment, it's a volatile investment, but some people have made a lot of money depending on when they've bought in at this point, and also depending on which cryptocurrency. But I'm going to just answer your questions from a pure, just objective tax point of view. And that is, the IRS, the government, not only are they interested in how it might be used in illicit manners, they're certainly interested in it from a revenue standpoint. Are we collecting taxes from it? Should we be collecting taxes from it? How much taxes should we have already collected that haven't been collected? So the government is aware, the US especially, and now there is absolute reporting, and it's in this of 2020, it's been put front and center. The government wants to know. You have to tell them at this point. And what the government wants to know is not just, it's almost a misnomer at this point, or a wrong thing to call it cryptocurrency. The government has made absolutely clear this is not currency. From a tax perspective, it is an asset. It is an asset just like you're buying any other asset, which means when you exchange it, when you use it, when you sell it, when you trade it, it's a taxable event. So if it's gone up in value and you exchange it for a different crypto, it's not a like-on exchange. There's not the same thing. They don't remember like-on exchanges now only apply to real estate. But even if you did this before the law changed, before the Tax Cuts and Jobs Act, and you go back a few years where we thought, let's say Bitcoin for Ethereum or one for another, the IRS is saying we don't even consider those to be like-on exchanges because we don't think these different crypto assets were similar enough. And then they get into different things where we have a lot of clients that they don't even know if and when they've had new crypto. You had hard forks and you had all kinds of things that happen. And they're like, that was a taxable. I didn't even know what it was back then. And suddenly I got some more crypto from a same crypto or a different crypto. So there was a lot of underreporting. And now the IRS is coming forward with their new form, and the government saying, we know there's a lot of unpaid tax. And now it's a time to collect it. Just to put in perspective, we were talking about the reconciliation bill, but there's the bipartisan infrastructure bill. This is where bipartisan, meaning 69 senators to 30, so absolutely approve this bill, 69 to 30, are in support of 1.2 trillion in spending. 550 is new spending, the other is old. So clearly bipartisan, Democrats and Republicans both want to pass this bill. There's no tax raises in it. So how are they going to pay for it? A big part of the way that they're planning to pay for this $1.2 trillion in spending is cryptocurrency tax enforcement. It's right in there, absolutely clear. We now are required to report it, but it begs the question for a lot of people, well, how are they going to find out? This is crypto. I mean, that's a big, what if I don't report it? What if I just, pretend? How are they really going to catch me? So
exactly.
What's the IRS been doing? Why do we need to be concerned? And the joke is sometimes you can run, but you can't hide. So the reality is crypto may seem anonymous and you may do lots of different things, but how is the government catching some of these fraud situations, and how are they going to go after some of these non-payers? And remember, if you don't pay your taxes, if you don't pay it, we're talking about penalties, interest, maybe even criminal, maybe even jail time. So when you check that box, if you lie and you say, oh, I don't have anything to report to the IRS, and it turns out you were lying, that could be a criminal problem, not just monetary. So how are they going to find out, and how have they been going after some of these fraudulent situations? How might they go after taxpayers? Well, the first thing is for some of the American exchanges, they're getting all the information. They're just doing what are called John Doe summonses. They went back and at least they said, all right, at this point, it's too much to ask for everything. So just give us everything that was more than $10,000. Well, that still gets a lot of people that have done more than 10,000. With Bitcoin trading right now over $60,000, there's a lot of people going back and forth. So maybe they, at one point, 10,000 may have seemed a lot, but at this point, we do a lot of transactions for a lot of people. Now, most transactions, if even the government will admit, are not necessarily illegal, dealing with any illegal activity. Most of the trading back and forth is just pure speculation. It's just pure trading. It's not necessarily, even though we read about these awful cases doing illegal things, most of the trading back and forth, even the government studies are showing, tends to be fully legitimate transactions. But if you're not reporting it at this point now, they have the information, the government has the information from the major exchanges. So some people would say, fine, I don't use the Coinbases of the world. I'm using these international ones, and I'm using these mixers where I put my Bitcoin in and someone else's Bitcoin. How are they going to ever catch you? And the reality is, for some of the bigger cases, they already are catching people. I'll give you a couple examples. How? It doesn't mean you're going to be, you run a risk, and they're only going to get better at it. But whenever Bitcoin, it's not really anonymous, it's just a number. But it is an identifiable tracing number. And what they're also finding is, even if you put your Bitcoin in and someone else's Bitcoin comes out, eventually and this is the other proposal, is eventually the government is asking for all cash transactions with banks. So if you're ever converting this back into cash and you're in the United States and you ever want to use US dollars, at some point, you're going to do a transaction where you have US dollars. And that's where the government can go back and get that information and start to say, well, where did this money come from? We certainly know what you make from income, but where did you get this other, whether it's $10,000 or $20,000 or $100,000? Now they have the information. It's just a simple question. You need to tell me where this money came from. And if you can't tell me, then you have to pay tax. It's not necessarily that you got it illegally. All you did was buy and sell crypto. But if you didn't report it to the government, not only will the government find out and make you pay those taxes and penalties and interest, if you check that box at this point and check it incorrectly, and you do that willfully, then it is considered to be criminal. And I'll leave you this one last, because this was a recent fraud case where the government doesn't just get your bank data, that doesn't just get the data and transactions of what you've done with any kind of US-based location. They also get your Google search industry. There was a recent one, I just kind of chuckle at this one, where the guy had actually Googled, do I have to report? And he lied to his accountant. He told his accountant, who asked him very simply, have you done anything with cryptocurrency? And he lied, but the government found it was absolutely willful. Because of his Google search, it was clear he intended to try to avoid the rules. So long way of saying, at this point, The government's just getting more and more information. They're getting better and better at tracking it down. So it's not whether crypto is a good investment or bad investment, but if you are going to do it, make sure you report it and fulfill your compliance correctly.
All right, so let's break this down into a couple of little things because I know that the folks that I talk to often about this, they just assume that just like if they had an investment account at some custodian, maybe it's at Schwab, could be at E-Trade, TD, doesn't matter, a large clearing firm that is responsible for keeping track of all the transactions in one's account. And at the end of the year, they send a tax form to the IRS to report the exchanges or the transactions. So I think most people just assume that the same thing is being done by Coinbase or some of the other larger, more recognized exchanges. Is that not the case?
So at this point, it's on you ultimately to report. And it depends on who. And at this point, some of the major ones are reporting, they're required to report, but a lot of people are doing multiple exchanges. And they're not necessarily tracking down, or sometimes they're not reporting correctly. But the government is getting this information from the U.S. industry at this point, or at least the above board ones. So the reality is it's out there, but it's still ultimately your responsibility to put it down there. And it's also your responsibility to go backwards. Meaning it's one thing if you're reporting correctly this year, but if there have been past transactions and you haven't reported, now there is certain statute of limitations. But the reality is, depending on how big the understatement is, normally it's a 3-year statute of limitations that the IRS can come back. But if it's big enough, it could easily be more, a 6-year statute of limitations. So that's the other concerning part as well, is when is the IRS going to go after this? How far back are they going to go?
And when you say it's up to you as an individual to report these, even if you're with one of the exchanges that are already providing that information, they might also be recent, so they may not have been the historic reporting. The question then is, well, how does one report this, given that the values trade and change so dramatically and not everybody has the records? What would your advice be?
This is where a good accountant can really come in and help. You really want, if you've got crypto transactions and if it's really on a significant enough scale that we're talking big numbers, make sure, this is not a do-it-yourself type of thing. You really want to do track down, and, ultimately the IRS isn't going to come back on, what was the date? If you can't find the records, it might be a matter of estimating it or giving your best shot, but really save your records and, do your best. Really, that's what you're trying to do, and report it as best as you can. But getting a good accountant in there to help, that would probably be decision number one in your favor.
Well, that sounds like the accounting or the options for good accountants is just going to all of a sudden shrink, because I can't imagine that there are a lot of accountants, or at least the majority of accountants are probably not up to speed and specialize in crypto reporting. And it sounds like that's on us as individuals.
Well, here's a big thing for accountants, by the way, because we all work with our advisor community, and that is that accountants need to become familiar with crypto, because that question, if that's not on one of your absolute questions that you're asking to clients at this point, meaning you don't put in your booklet and make sure your client answers whether or not you did crypto. If the accountant on their own just says, oh, I don't think they have any, and marks the box, no crypto, that accountant would face criminal charges too. So the accountant, by signing their name on that return, they are obligated to talk to their clients and make sure. Now, if the client lies to them, they're off the hook. But if the accountant doesn't ask, if the accountant isn't familiar enough to know and just on their own marks that box, they're facing potential criminal liability. But I do want to at least put in one more thought as well, because it's not just about taxes. It's also about safety of assets, and not just people stealing your crypto, but if something ever happens to you from a planning standpoint, forget about estate and gift taxes and planning for your kids and grandchildren, but even your surviving spouse, your family members, and that is, who's going to be able to get to that crypto if something happens to you? And so it's not just about reporting for tax purposes, it's about keeping those ID numbers. If 16 digits, that's a lot to remember, or however many, and having it in a safe place where someone else can access it. if you get hit by a car tomorrow, because the problem with crypto is it just disappears. And depending on where you're holding it, if someone can't get into that account, then it's gone forever. And unfortunately, from a planning perspective, even though we hope we'll all live forever, and especially young people that tend to be investing that have plenty of, mathematical or scientifically, their life expectancy could be 50, 60 years. If something does happen to them, if their surviving family members or loved ones can't get to the crypto, then it's gone.
So that's actually was going to be a next question as well, because I keep getting that question asked as part of people's estate planning. But before we move on to that, again, just with the taxation, if someone, let's say, who's listening or watching a replay of this conversation has invested in crypto and they've made buying or selling or had buying or selling transactions this year, it is on them to report each and every single one of them as best as they can, but they should also go back, it sounds like, and get a history. I know you said especially the significant amounts. Is there kind of a line in the sand where something is significant and is not significant underneath?
I throw that. I mean, the reality is the tax answer is everyone should do it. Significant means how much penalties and interest. If it's a few $100s and you're close enough, and the reality is, even if I did make a mistake, it wouldn't be the end of the world. Versus, if you're looking at tens of thousands, hundreds of thousands of dollars, and you could fix it now, as opposed to it's always worse when the IRS finds out about it on its own.
Okay.
And so if there is something out there, especially if it could be argued it was willful, meaning you knew or should have absolutely known and were doing it incorrectly, this is the chance, to get things right. And once again, knowing that the government only wants to increase enforcement in this area. In fact, a lot of the money that they're looking to collect is so they could go after not just crypto transactions going on today, but all the crypto transactions that have gone over the last few years. So the only thing that the IRS, just to give you a little, with all the new rules that they put in, buying crypto is the one thing they made clear is not the issue. If you didn't use other crypto to do it, if you want to go out and buy it, that's fine. But anything other than that, almost, selling it, owning. So it's not like cash. If you go and buy something with your cash, you don't suddenly get hit with a big tax bill. Crypto is not like that. So if you use crypto for any other purpose, it's going to be a taxable event.
Right. So if you pay for things with crypto, you have to record it as if it was a sale.
Yes.
And so that was actually, I have two questions related to that, and we can move on. One is, can you offset, let's say, gains in your crypto account with losses in your traditional investments? And vice versa. If you had a loss in the crypto, can it offset your regular capital gains? I know it's limited, but are they offsettable?
Yep. So that's where some planning comes in, especially with people are talking about wash sale rules and stuff like that apply in the currency markets, with liquid securities and all that. But once again, comes in with working with good tax advisors, good wealth advisors is certainly, not everything has gone up in value, and being able to take advantage of losses, which is what, with our clients, we should be doing with the regular investments, non-crypto, and not just at the end of the year. This is a prudent strategy you use throughout the year, harvesting losses if and when you can to offset some of those gains.
Yeah. Okay, good. And then the last question on this I had was, given that the IRS is more interested in not only raising more tax revenue, but particularly from crypto, is it likely that someone with high activity or some degree of activity in crypto space is at risk of or higher risk of audits, or is it still more or less random? Or do you think that is an area that people should be concerned about?
Well, now with so that nobody knows for sure. We don't know what, the algorithm or the red flag is, but certainly at this point, one of the things that worry is, oh no, if I check that box that I did anything with crypto, am I going to be suddenly flagged? And we don't know, but the answer could be yes. It's certainly, it also depends on to what amount. We don't know what that magic number. If it was a few $100s, is that certainly a red flag? Also, what was the amount compared to how much you make? Was this 80% of what you made last year? Was it 2% of what you made last year? So that could also be part of the equation or algorithm that goes into it. But I do want to bring up, one last thing also, and this is, unfortunate. But the big thing, especially people listening to this thinking, am I missing out? Is it time to jump in? And once again, I can't help you with timing, but what I can tell you is just be careful of the fraud that goes on in the crypto world. And that is, there's a lot of newer cryptos, there's a lot of crypto transactions, there's a lot of running up values that's going on behind the scenes. And the government's also going after that as well. And NFTs are another example. So I'll just give you an example. Let's say I've got $5 million worth of crypto, and I've got this NFT that I've created. I could technically sell my NFT for $5 million of crypto, and then I could make the argument that the NFT is worth $5 million. But I'm doing this transaction with myself. And then what happens if you're doing this and you're collecting money from other people or you're running the business, a lot of it is going to be subject to some serious breaking laws, criminal activity. But the problem is it's hard, you're normally with crypto not going to find this out until after the fact. So just be very wary of anything you're seeing on social media or a lot of these new issuances and all this, that there's just a lot of rampant fraud and illegal activity going on in that world. And just don't, do your best and, be prudent, could be thoughtful. These are not publicly traded stocks. They're not subject to the same SEC, oversight in advance. So just be careful. A lot of these are very, very risky investments from a fraud standpoint as well.
That's a good word for caution. And I know that I've held you for quite a while and you're a busy man and you've got a lot to do, but I do want to ask you that final question that was related to the estate planning is folks that do own it, they're investing in it, they own it, it doesn't matter, but they're legitimate owners. They're not involved in any kind of scheme. They're not originating these things, but they're concerned that, gosh, if something happened to me, what happens to my crypto? What are some of the best practices that you might recommend to your clients or other folks? How do they keep that security safe, or that asset? I know I can't call it a security, that asset safe, and ensure that it has some continuance beyond them.
So all of this is developing really quickly from an estate planning perspective. It's very difficult. A lot of the big banks won't touch it. They don't want to be responsible for the code, having it getting stolen. Some of the bigger banks some of the big custody banks are trying to figure out, it's not set yet, but maybe for some of the bigger clients that have, let's say, more than $50 million worth of crypto, finding a custody solution. So because we can't have an individual at our firm responsible for some secret code that could got stolen or, and it could just disappear. So there's a lot of planning needs to be done. One of the solutions is simply just having a safety deposit box with your password. So if something happens to you, your spouse or other loved one, your future trustee or executor can go and get that password. And so I know it's old fashioned, but we would say it, having an actual hard copy with your passwords. Now, for an investment account, for anything working with us or at any major bank, you can prove to us eventually that you're the trustee or you're the executor, and eventually we'll see the filings and we'll know it's legitimate. But Bitcoin and Ethereum and other cryptos, there's no one you can go to try to prove that you're the legitimate trustee or executor. If you don't have that code, you lose. Where it really gets interesting with some, and this is more in my world, and I'll leave you with this final sort of high-end thought, and that is, what are sort of the really high-end trust companies doing? How are you coming up with this? How are the really advanced attorneys planning? And where we're getting some good creative solutions is you can have, let's say, a corporate trustee, and we could be a corporate trustee in a place like Delaware, let's say, so you have no state income taxes for out-of-state residents, and you're setting up a trust for kids and grandkids. And while we right now are not able to trade or do anything with the crypto, we can be trustee of a trust that owns an LLC. And that LLC may be managed by individuals, friends, relatives, successors. And those are the people that have access to be able to do the necessary trading if anything ever happens to the person. So you're still getting the trust protection, the trust tax rates, all of that, the better state income tax, asset protection, but it's all being done within an LLC. And what we're also seeing in Delaware, which you can't do in California, in Delaware, you're able to bifurcate trustee duties. So as a trustee, we might have our hands tied and say, well, investing in crypto is too risky, or we just can't have that type of volatility if our job is to preserve these assets for kids and grandkids. We can't necessarily. So as a California trustee, maybe have their hands tied. Delaware, we could be what's called a directed trustee, where we might be responsible for the accountings and the information and the reporting and all that. But there could be another, you could even call it a special trustee or a crypto trustee or an investment advisor, whatever you want to call it. You're able to actually divide that traditional trustee role to have someone specifically dedicated for the crypto transactions. And sometimes people can even be creative that they might have two people and each person only has half of the code. So in order to act together, they have to come together. So a lot of creative ways for doing it, and especially for some of the bigger crypto holdings where it's going to be worth it. But it's all developing very, very quickly, and it's very exciting.
It is. Well, we can leave on a positive and exciting note, as we mostly think about taxes. Of course, that's the feeling that we get. But this is a really big topic, and I think there's going to be a lot, obviously, that develops out of it. But because we can't name a trust as a successor owner and a crypto, I could see how maybe applying some of the kind of traditional pen and paper, old school methods with this cutting edge technology is actually the right thing to do. And yeah, thank you for that. Any final thoughts before we wrap up?
Well, I'll end with my final thought that was the same final thought to what to do about the legislative tax changes. And once again, and I know we both believe in this and everyone should, and that is, you've got to have a good group of advisors, rely on that team of advisors, have them work together. I mean, whether it's crypto, whether it's taxes, whether it's just your overall wealth plan in general, having that core group of advisors working together, it's worth, I know there's a lot of do-it-yourselfers. I know some people look for the least, the cheapest option, but it's a matter of whatever you pay now to do correctly will be worth exponentially more savings than doing it wrong today.
That's a very, very good point to end on. And I know that you and I are of the same mind when it comes to teamwork. So I want to thank you again. This was wonderful. I know this is a busy time for you, but I really appreciate you speaking to all of us.
All right. And, well, Roman, thank you. And I hope this helps everyone. And thanks so much. I enjoy the rest of your day.
Thanks, Justin. Be well.